Happy Friday, everyone. I'm Robert with OpenLane Funding, and today we are closing out our 2-week segment. I hope everybody got a donut today because guess what? It is National Donut Day. I know my wife and I, we both got our donuts and they tasted delicious. She went to her favorite spot, which is about 30 minutes away. It might be a round trip, but the donuts were worth it. I was skeptic of the drive. I stayed home so she could get it done. Today, what we're going to talk about are the hottest and coldest markets, the final action plan, and everything you need heading into the most consequential weeks of the year. That's the new Fed Chair's first Federal Reserve meeting in just 10 days. So let us do this. So let me give you the rankings. The hottest overall market in the country for spring 2026, according to the Wall Street Journal and Realtor.com composite, is South Bend, Indiana. That is up 27.5% on the listing prices year over year. That's up 14% or 14 positions in the rankings in a single year. I know that if you guys have been paying attention, if you guys have been watching the videos, we've said South Bend, Indiana has been heating up for the last couple months. So you're missing out if you're not jumping into South Bend, Indiana now. Appleton, Wisconsin is number 2. Canton, Ohio is number 3. The entire top 20 is a sweep of the Midwest, Mid-Atlantic, and New England. Not a single Sunbelt market made the top 20. And that's going on a 30-plus month streak, and it's continuing. For the single monthly Realtor.com hottest market rankings, you got Springfield, Massachusetts, which has held that number 1 spot for 2 consecutive months. Home sales in 23 days with an average listing that draws 3.6 times the national average in views. That's amazing. It shows that the market's heating up, right? Redfin's pending sales data hit a 4-year high with the week of May 10th. That's up 9.6% year over year, and that's the highest since 2022. Pittsburgh and Minneapolis each led with plus 17.3% year over year gains. Then the rates climbed up to 6.5%, and then the following week after that, they slipped to plus 7.8%. What that shows that the demand is rate elastic, but the demand is also real. U.S. News Best Places, the 2026 to 2027, just crowned Carmel, Indiana, the number 1 place to live for the first time in the history of that ranking. Fishers, Indiana is number 2, and they are both Indianapolis suburbs. The Midwest thesis is showing up across every major ranking simultaneously right now. On the cold end, the bottom 25 of the Wall Street Journal ranking are 44% Florida metros and 36% Texas metros. Memphis listing prices are down 12.9% year over year and deepening. Toledo, Ohio went from the number 1 hottest market a year ago to a number 38 today. That is down 37 positions. That is the most dramatic single-year market ranking collapse in the data. But I want to give you 2 surprise recoveries that are worth watching. First, New Orleans for the for sale market. It closed sales hit 1,120 in April. That is up 6.2% year over year. Average price went up 4.7% year over year. Days on market went down 12%. In Jefferson Parish, average prices are up 14.2% year over year. For the for sale market in New Orleans is generally recovering, though the rental market there remains the coldest nationally at a negative 13.1% rent year over year. So split market. But it's a completely different story depending upon what you own or what your investment strategy is. The second surprise is going to be Austin, Texas. Listing prices are still down 9.5% year over year, but home sales are actually up 20% year over year. And depending upon and the pending sales are actually up 15%. Foreclosure starts in Austin surged to 150% year over year from 158 to 396. Ouch. And which is creating de-stressed inventory. Austin is the most likely Sun Belt because of that to show price stabilization. And that's going to happen in the back half of 2026. On the rental side, San Francisco just recorded an all-time rent record, and that is $3,850 per month for a one-bedroom, and that is up 19.9% year over year. That is 100% driven entirely by artificial intelligence sector. The Silicon Valley just entered the top 5 largest market rental competitiveness index nationally as a new entrant, if I can get that word correctly. Chicago is the number 2 rental market nationally on the Rent Cafe Index with the largest competitive improvement on any major market. It's up 9.5 points, and Wichita, Kansas holds the number 1 spot for all markets, including small ones, at 91.0 on the index. And that is all driven by the defense sector employment. Providence, Rhode Island is the number 1 Zillow hottest rental market for the summer of 2026. That's a 5% rent growth with a 5.1% vacancy. That is the lowest concession share in the top 10 at 12.9%. Cold rental markets, San Antonio now at 16.1% rental vacancy, is the highest of any major city nationally, and it's worsening. Austin is sitting at 13.3% vacancy. Dallas Fort Worth just hit 20-year high in multifamily vacancy at 12.6%. I wonder how much of that is due to new construction apartment complexes. I know a lot of lenders right now they're slowing down on approvals. Apartment complexes and major developments are becoming really hard to get approved right now due to the mass amount of apartment complexes already completed. And as you see, vacancy rates are being increased. I know locally we had a vacancy rate that's disqualified from some lenders about a year or two ago because there were so many apartment complexes being built and still being built that they were nervous about where the market was going to be for the rental market. Here is your full investor action plan to take into June and beyond. Step 1, June 16th and 17th is the most important near-term catalyst for your financial cost. Warsh's first federal open market committee is going to happen. What you need to watch out for is 2 things. 1, whether the earning basis language is removed from the policy statement, which that alone would reprice mortgage rates 25 to 50 basis points. And 2, whether the dot plot changes. If you have a rate lock expiring or a deal in underwriting, know your timeline around those days. Step 2, the bifurcation trade is clear and confirmed by every major data source. The Northeast and Midwest supply constrained markets like South Bend, Hartford, Chicago, Milwaukee, Akron, Providence are where appreciation is happening. The Sun Belt is where distressed acquisitions are happening. Do not mix the thesis, right? Know which one you're playing on and underwrite accordingly to your deals. The SFR recovery is starting. Innovation Homes and AMH both showed a new lease rent growth turned positive in April. If you're acquiring single-family rentals in a tight supply market, you are now entering at the early stages of the rent recovery cycle. You're not at the peak. That is the right time to buy. Step 4, Washington state regulatory changes are here. The eviction diversion ordinance is active. Senate Bill 1626 takes in effect June 11th, and the Plan Spokane 2046 map was adopted, pointing toward upzoning on single-family zones for missing middle housing. Idaho accessory dwelling unit by right takes effect July 1st. Every one of those creates either a risk to model or an opportunity to exploit. Step 5, get pre-approved and stay pre-approved. Washington state REOs are up 115% year over year. Foreclosure auction volume is at a 6-year high. The distressed deal flow is building. The investors who move when opportunities show up are the ones who already have their financing lined up. They're not the ones who start the process after finding the deal. This has been our 2-week segment in the real estate market series of the end of May. I'm Robert with OpenLane Funding in Spokane Valley, Washington. If you have a deal ready to move, a DSCR, fix and flip, bridge, new construction, multifamily, whatever it is, commercial, residential, let me know. I'm here for you guys. I'll see everyone on Monday. Have a fantastic and safe weekend.